Wealthy and Wise is your guide to value investing, powered by TeamInvest.
Welcome to Wealthy and Wise. Well, this week we're following the money to find out what executive pay and incentives can really tell you as an investor. We'll unpack how to read remuneration reports through a value lens and try to understand why incentives can tell you perhaps more about future returns than just the headline numbers. And we'll compare a few good practices against those that are perhaps not optimal. And we will, of course, answer a viewer question as well. So stay with us as we add some value. Well, executive pay can be one of the most overlooked but most revealing parts of any company report, because incentives don't just reward performance, they shape behavior. So before we go head to head, let's get a view on company reports, just to understand them a little bit more, with Howard Coleman from TeamInvest, and joining us for a retail shareholder perspective is Rachel Waterhouse, CEO of the Australian Shareholders Association. It's really great to have you both here as
good
always.
To be here.
Thank you. Rachel, I'll just start very basic. Why do incentives matter?
Incentives matter because they shape behaviour and performance, and so having the right remuneration structure that sits around a management team and a CEO is important for what will be delivered and rewarding that right behaviour as far as what a retail shareholder expects.
Yeah, and this is something that, Howard, the board is primarily responsible for setting?
Yes, and or at least for the CEO and one or two of the top people, and then the CEO is probably responsible for those lower down the chain. And I think the other half of it is not only do good incentives create better performance, as Rachel was saying, but you also want the structure to be such that the people who are the least competent and the ones you'd rather didn't stay working for you leave of their own accord because the incentives don't work for them.
Right, okay, so it's a little bit more complicated than just thinking, there's a bonus for this or a long-term incentive for this. Remuneration reports can be dense. So how do ASA members, Australian Shareholders Association members, approach understanding remuneration reports?
So they can be dense, and it's really about understanding the company you invest in and taking the time to look at an annual report and the remuneration structure and look at the short-term incentives and the long-term incentives and think about, is that rewarding the right behaviour? So that can be really complex. There can be a lot of jargon involved in it, but it is important to look at that detail to understand, are the right incentives there in place? We also look at it when we're looking at companies and put it in the voting intentions report, the view of the retail investor.
Mm-hmm. Okay, so obviously very important. Howard, are they more important than the actual headline numbers or the profit and loss?
Well, certainly once you've already established that a company is a great business, so the fundamentals are good, and therefore you want to invest in that business. It's got high return on equity, low debt, its earnings are growing. So you're now keen to put some of your money into that and be an owner. Then they become very important indeed, because the remuneration structure tells you what the management are going to be trying to achieve. If you read a remuneration report, and at the end of reading it, they are very dense, by the way, so it's a bit of work sometimes. But if at the end of reading it, you can't say, I know what this company is really trying to achieve. And how do I know? Because the remuneration structure is trying to get that to happen. And that's why one of the most important things in a good remuneration report is clarity. The management must understand what the board wants them to achieve, and that if they do achieve that, they'll be appropriately rewarded. And the shareholders, as the owners of the business, should be able to read it and say, aha, now that I've read that, I know what this business is trying to achieve. Does this fit with what I want in my portfolio, or doesn't it? And if you come to the conclusion it doesn't, well, even though the business basically looks sound and good, there's always more companies that look good than you've got money to put into. You only want about 20 companies in your portfolio. Ditch that one, find something else.
So you would say complexity is a bit of a red flag?
Yeah, definitely.
Yeah.
What complexity tells you as an extra thing is that the board don't really understand the business terribly well, because if they've landed up with an extraordinarily complex trying to achieve everything remuneration plan, how do they expect a manager who's in that role, a CEO, driving home from work one evening to figure out how am I doing according to my incentives? Well, there were 16 of them. I'll have to do a whole analysis for the next week to figure out if I'm doing okay.
It's interesting, Rachel, because I think that from a layman's perspective, retail shareholders' perspective, sometimes you just look at the ultimate figure, But what you're saying then, total pay can be reasonable, but it needs to be taken into context?
Yeah, I agree with a lot of Howard is talking about, because you do invest based on the financial situation of the company, and then you look at this. So you need to know, as a retail investor, in the layman terms, you would want to know, is this the type of pay that I would expect a company CEO of this size organisation to be paid? So when we're analysing these reports, we're thinking about, well, what do peer CEOs get paid? So you want to know that it's realistic. You want them to be thinking long term. So you want to be rewarding behaviour of a CEO that thinks long term and not short term. So for example, one example I was thinking about is Qantas. So a lot of challenges there at Qantas. And so one of the changes they made recently was to reward reputation. So yes, be rewarded for all of the financial metrics that you would expect, but bring reputation in, because that was a challenge, and generally there's a link between reputation and also purchasing and the consumer. And the CBA, after the Banking Royal Commission, was a good example of, there was a lot of issues in the banking sector, is how are these CEOs and management teams being rewarded, and to think more holistically around that. So the CEO pay and the quantum, it's important, but it's really important what they're going to achieve, and also that it's long term, because you really don't want those short term decisions. So we like to see that the long term incentive is over 4 years for a CEO. So it's not all about what they've achieved in the last year, and it's about what they achieve over time, and they don't get all of their remuneration until they've passed that test of after 4 years.
Yeah, it's fascinating. So do you believe that you can tell a lot about a company in terms of future returns, risk, and capital allocation by the way that their incentives and remuneration is set up?
Oh, absolutely. I mean, if a company is very capital intensive, and Rachel used an example there of Qantas, which is, it's a very capital intensive business. Mining is a capital intensive business. Oil and gas is very capital intensive. So the shareholders, who are the owners of the company, the people who put the money in, they're being asked to put a vast amount of money into a business to get a reward on that many, many years down the track. So the incentives for the management should be to make sure that if it's an oil and gas project, $20 billion that's been put in now is going to return a lot more than $20 billion, even if adjusting for time, down the track. On the other hand, if you're investing in a company where they have very short-term contracts, everything they do, they start it and they finish it in a week or two, then a long-term incentive is much less important. I'm not saying one shouldn't have one, but it's much less important. You want your staff getting out there and making things happen now. I worked in an organisation where everything was pretty much incentivized on a daily and weekly basis, because that worked for that company. Would it work for most companies? No, definitely not. It was a very peculiar type company, but it worked really well for them. And having long-term incentives in that company was a total utter waste of time, because almost all the staff were university students working during their holidays or a couple of nights a week. So a long-term incentive was never going to happen, because they were going to go on to become doctors or lawyers or whatever.
Okay, so in a good business, you've got good financial metrics. What you're saying then, Rachel, is incentives, if they're off, if they're not clear, if they're not aligned, that it can actually destroy value even in a good business.
Absolutely. And the incentives should be on financial metrics, but other ones such as culture as well. So you may have different proportions, but it makes a difference because you're rewarding the right type of behaviour.
And I think the only thing I would add to that, completely agree with Rachel, but I would just add, and they've got to be measurable. Because the trouble with things like culture is not that there's anything wrong with it, but you have to describe how are you going to measure it. so that the owners of the company know how it will be measured, and the executive who's trying to achieve it and get that bonus knows how it's going to be measured. You don't want the executive going home at the end of the financial year and saying, I wonder if I qualified on my culture bonus or if I didn't, because I don't know how they're going to decide. They're going to have a meeting and they're going to decide how it qualified or how it didn't qualify. Well, that's no motivation.
Yeah, and on that, it's also around not gaming the system as a retail investor, because potentially you do a staff survey, you make them all happy, you do something and it could bias the results. So you really want to look at performance over the short term and long term and just make sure that the system cannot be gamed.
So how should investors, Rachel, I'll start with you, question for you as well, use remuneration reports alongside CEO and chair reports?
So CEO and chair reports are really good from a strategy perspective. So you'll be reading that, thinking through, do I believe in this company? What they're saying they achieved, really what they achieved, and I'm comfortable with the strategy going forward. So a lot of the content that sits within those, that's where it's going. And, you know, there's a bit of spin potentially too at times in chair and CEO reports. You hope that there's not. But the remuneration report is really the guts of how are we remunerating within this organisation. And it can be complex, there can be jargon, and those are red flags. So if you see that and you can't understand it, it's potentially a red flag that you may not want to invest in that organisation. As Howard said, if it's not clear, how does the rest of the management team know and the staff know? So I think they all have to be read together. It's really important as well that chair and CEO reports are very much a point in time. So as you are looking at your company, you should be thinking through, am I comfortable where they're at as they do their earnings reports, etc. over time.
So yeah, you can tell through.
Yeah, and in fact, one of the very amusing things to our members often is you'll read a chairman's report and a CEO's report and you say, aha, I know exactly what this company's trying to achieve. These are their aims, they've explained it really well, I'm really happy. And then you read the remuneration report and you discover they're motivating and incentivising the executives to achieve something completely different. Then you say, well, hang on, what I just read in the CEO and chairman's report's rubbish. Either that, or they've completely misdesigned their REM report. And seeing as probably more time went into the REM report, because a lot of other people had financial interest in making sure it worked for them, the chances are most of what you're reading in the chairman's report and CEO report is rubbish, because that's not what they're motivating the people to achieve. Some years ago, we were in Adelaide, in our group in Adelaide. There was an Adelaide-based company. It's not one that passes our filters now. And at that time, we looked at the remuneration report, and the remuneration report clearly was designed to motivate the executives to make as many acquisitions as possible. And when you read the chairman's report, in the chairman's report, he said, we've now made a lot of acquisitions in the last while. We don't intend making any acquisitions in the near future.
Yeah.
So we looked at that and we said, how can we become owners of this company? How can we take our hard-earned money and put it into this company where what the chairman says in his report is completely different to what he's motivating the executives to do?
Even I can say that's a red
Absolutely.
flag. All right, so Rachel, before we have to let you go, give us the ASA's position when it comes to remuneration and incentives, just in a nutshell.
We want to see short-term and long-term incentives. We want to see financial metrics and some softer ones that make a difference on the organisation around culture. And that's pretty much it. And as far as when we meet with chairs and chairs of remuneration committees, we're listening to, do they understand how that incentive structure works?
So they're not rewarding poor performance as well.
Yeah, and the governance that sits around that too is really important, that it is an independent chair and it's not a company where effectively they're making their own decisions on their pay. There needs to be that separation and good governance.
All right, well, thanks for the good work you do at the Australian Shareholders Association. Rachel Waterhouse, appreciate you coming in. She's the CEO there. Howard Coleman will be sticking around as we go head to head. Well, understanding incentives in theory is one thing, but spotting them in the real world is another. So in this segment, we go head to head. So we'll try to do a little bit of a compare and contrast to what remuneration structures and different ones reveal around management behavior, risk, and ultimately You got it, shareholder returns. And of course, we'll do it all through a value lens with Howard Coleman, who's joining us from TeamInvest again. Thank you. And Sanjee Narendran, also from TeamInvest. Now, I think it's pretty fair to say, Howard, this is actually a bit of a pet love of yours, isn't it?
Oh, very much so.
Yeah.
I've been involved in remuneration structure since I was a uni student doing physics and maths, and the only way I could pay my way through university was to work part-time. University was expensive in those days. It wasn't free. There was no HECS in South Africa. So I worked selling encyclopedias. And the big boss of the company in Southern Africa heard that I had a background in mathematics and physics. This is before spreadsheets. And he used to every now and then pull me out of whatever I was doing during the day. We were selling at night, whatever I was doing at the day in the holidays, and call me in and say, look, I'm thinking of changing our commission system for our sales reps. If I change it and I increase getting cash sales, for example, by that much, but our total sales go down by that much or go up by that much, am I going to be better off or worse off? And I used to go away with a pencil and graph paper, because there were no spreadsheets, and build what was what we today call a spreadsheet model. I mean, it's much easier today, of course. I got very fascinated, because what I discovered from this guy Frank was that every change he made in how he paid people made an almost immediate change in the results they got. If he changed it well, the results went up in that week, not in that year, in that week. If he changed it in a way in which it was perceived badly, results went down in that week. And I looked at this and I said, this is amazing. Little changes make such a big difference. So I've been fascinated by REM reports ever since then, and I've spent many hours over the years designing them.
Okay, well, let's just get a bit more, because Rachel Waterhouse, CEO of the ASA, mentioned quantum. You've mentioned clarity. So clarity, alignment, and quantum. Can you walk us through it, starting with clarity?
Yeah, this is what we always talk about in TeamInvest. I mean, the first thing to, I think, as a shareholder, as an investor, is to remind yourself you're an owner of this company. And you've probably been successful in life, because otherwise you wouldn't have any money to invest. So whether you've got a giant amount of money or not a giant amount, but some spare money to invest, you've been successful. If you cannot understand the remuneration report, then either one of three things. The management is deliberately, or the board, deliberately trying to pull the wool over your eyes so that you don't understand it. Well, that's a red flag. You don't want to invest in that company. That's the least likely, but it could happen. Alternatively, the board themselves don't really understand the business, so they can't explain the REM report very well, even though it may be a good one. They're incapable of explaining it. Well, that's a bit of a red flag too, if the board can't explain why they do what they do. And so really, you've got to be able to read it and say, is this clear? Do I know what matters in this company, what people get incentives for, and can I clearly explain to my significant other in life or whatever, I read this remuneration report and the main things are A, B, and C.
So alignment is what you referenced earlier, that the execs know what they're trying to achieve on a day-to-day basis, and that it's aligned as well with what will drive shareholder returns.
Absolutely. So taking a couple of simple examples, if a company is very capital intensive, like a mining company, a logical way to remunerate people would be to have bonuses based on returns on invested capital, because they're going to be investing lots of capital. So if we get a good return on the capital, that will drive the share price higher. The shareholders will like it. It's an easy thing to measure. So the management can look at it and say, if I spend that 10 million on that project and it only returns 9, I won't get a bonus, so I better not do that. But if it returns 20, I'm going to get a really big bonus. So that's alignment. But for a company that's not capital intensive, return on invested capital would be nonsensical. You'd want earnings per share. And for most companies on the stock exchange, earnings per share tends to be best aligned with shareholders' needs, and it's measurable and auditable, so the management know if they're achieving it or not.
And just very quickly, quantum. So that's whether execs essentially are being paid appropriately, correct?
Yeah, and appropriately means that the least competent should want to leave and go elsewhere so that you get rid of them without having to fire them and pay them extra to get rid of them. And the most competent should definitely not want to leave. And if a headhunter phones them and offers them a job, they say, no thanks, I'm on a great structure here, I'm staying where I am.
Okay. All right. So Sanjee, let's bring you in here. What is, an example of a company or a structure that you think will ultimately lead to getting things right, both for shareholders and execs?
I think it's best when we keep it simple. And, I have a day job. We run looking after TeamInvest and our funds and so on. And everybody else, these CEOs, they're running businesses, and those businesses can get complicated. There's a lot of levers you can pull. There's a lot of ways to kind of achieve growth. Now, it's important to keep it aligned, but I also do consider my income with my decision making. So if I'm going to make a decision where I know that I'm going to invest a significant amount of capital, the returns are going to be low, then I'm going to pull back from those type of things. And I want to know that, is that going to align with my bonus? Am I going to get rewarded for taking these type of either a good decision or avoiding bad decisions? And so if I can't quickly work it out when there's too many metrics and there's too many different things that can happen at a given point in time, that I have no way to calculate what my bonus might be at the time of making a business decision, then it's going to complicate the matter, and it's not going to incentivize me or any of the CEOs out there.
Yeah. Okay. So what does a poor I'm trying to get to the heart of this for investors. What is a very big red flag? What is a poor remuneration structure?
Well, one that's very common and is terrible, if you just put the hat on of a senior executive, or in Sanjee's role, the person in charge of a quite sizable organisation, is a comparator, where they say total shareholder return against a comparator group of 20 other companies. Well, until the 20 other companies have their audited results come out after the end of the financial year, you don't know how well you did. You could have done what you think is a terrific job. The company's done exceptionally well, but you don't qualify because these other companies' share prices went up. It's got to be something you're in charge of as the executive and that you can make happen. So if Sanjee in his role can look at something and say, if I do that, I know whether, and it works, I know I will get rewarded for it. If it doesn't work, I know I won't. But if he looks at it and says, even if that works, I still won't know if I qualify because 20 other companies are being compared with it.
Yeah, well, but what about from a shareholder's point of view, though? Any metrics that would immediately worry you, or any, any sort of remuneration structures that, shouldn't be used at all?
Well, here's one that I'm sure almost everybody, as I did the first time I heard it, thinks a great idea, but it isn't. Total profit. Now, obviously viewers are going to say, surely, Howard, do you want the total profit to go up every year? Of course I want the total profit to go up every year. But look how you can game the system. If it's based entirely on total profit, and I'm the chief executive of that company, I look at this and I think, gee, if we make an acquisition, our total profit will go up, even if I overpay for the acquisition. So why don't I go out and spend $50 million and buy this business that only makes $1 million a year, which is a nutty thing to do. It's a totally stupid idea, but our profit now goes up by $1 million. I'm now going to qualify for my bonus. So total profit is a terrible idea. Or EBIT, anything that can be gamed by making acquisitions tends to drive executives to make poor acquisitions. On the other hand, earnings per share usually avoids that, because if you're going to make an acquisition, you may have to issue more shares. So now you've got to hold back and say, I only want to do that if it's going to be earnings accretive.
Yeah.
So there's one example.
Have you seen, Sanjee, any examples where poor incentives have destroyed value?
I see it all the time, but maybe not in the obvious ways. I mean, I've been over 25, 30 years in the market now, so it's looking at a company that they get so overvalued, and sometimes the market does it through its own exuberance, but sometimes it's because management are incentivized to get their share price up. So rather than focusing on business things and things that they can actually control, they go out and do a lot of publicity in the market and a lot of focus on share price as opposed to the business operations, which is great, for shareholders that are in it for the short term, but you can never hold the price at such high levels. There's a runway where that kind of falls off. And you see that, there's certain companies that are always in the press, they're always making announcements, they're always doing something to really game the market or game the investors, or maybe even game the super fund managers and those kind of things, to start pulling their share price up, getting into the index, those kind of things. In terms of a business, if I know that the business is going to be stable over the long term, it grows its earnings, then I don't really care if it's in the ASX 20 or the ASX 50. That'll impact its share price, but over the long term, it'll go in and out. These type of businesses.
An extreme example of that, of course, are companies that make no profit. And you know what I think about them. But companies that make no profit, yet they're constantly issuing announcements, being in the news, being interviewed, talking their share price up. Before you even look at the remuneration report, you know the answer. You don't even have to read the remuneration report. When you read it, what do you discover? Total shareholder return is the biggest reason the executives get a bonus. So what does the CEO want to do? He doesn't want to run the business well. He wants to talk the share price up. It doesn't matter if it never makes a profit. Yeah. He gets a big check if he can talk the business up.
So here's an idea, Howard. Should all companies use similar remuneration structures, or just to simplify things, to make it like for like, apples for apples, or does it need to be company, sector, industry specific?
More the latter than the former. I mean, obviously there's some things that are clearly bad. We've given a couple of examples now. There's some things that are clearly good, but you don't really have a one size fits all. So the first, when you get a company's report, you shouldn't ever read the remuneration report as the first thing, even though it's extremely important. First get to understand the company. Once you get to understand what the company is, what it's doing and what they say they're trying to achieve, then you should read the remuneration report and say, does this fit with us? Now, generally in TeamInvest, we like earnings per share as the main metric for bonuses. But there are some companies we'd look at where we'd say, well, for this particular company, there'd be a more appropriate measure. In this case, say a return on invested capital. Or in this particular case, developing a new product because we know that the product that they currently have is coming to the end of its useful life. So it's important that they develop the next iteration of that. So you need to understand the business a bit, but it's all very practical, common sense stuff. I mean, people often say to me, oh, Howard, remuneration report, I'm even talking about our TeamInvest members, remuneration reports are terribly complex. Well, they're only complex because they're written in a complex way. But if you say as a plain, practical, sensible human being, does this sound right to me or does it sound wrong to me? The chances are 9 out of 10 times you'll get it right.
So clarity, alignment, quantum, and then they'll become wealth winners. So Sanjee, simplify it for poor folks like me. What is a simple check investors can do before they enter a position, before they buy into a company, before they become owners of a company?
Well, I mean, just reading the REM report. Now, cut out all the stuff that has to be in there for compliance reasons, but just have a look at the simple, what is the STI, what is the LTI, the short-term and the long-term incentives, what are they basing it on? Because that gives you a really great insight into what the board's thinking, what are they trying to achieve, but even if you've got a few structures of your own that you've written down and you know, okay, I like this and I don't like that, after 5 or 6 REM reports, you'll start to say what you do like and what you don't like, and check them off against some of the metrics that you see.
Yeah, and as Sanjee was saying, when you read it, focus on what they're telling you, not the tables of figures that they're required to give you under the law, because there's at least 3 sets of tables that they have to give you, which all seem to contradict one another, because one's required under accounting standards, one's required for the ASA, there's reasons for them. But I've seen often people say to me, oh, but I can't understand the tables. Don't bother.
Yeah.
I've got a maths degree. I don't bother with the tables either.
Right. Well, guys, I've got to say, you've been very polite, not naming and shaming, despite my best attempts. I did try. Maybe we'll revisit it, because this is obviously a passion of Howard. Stay with us. We've got your question answered next. So it's time for You Ask. Don't forget to send your questions to wealthy@ausbiz.com.au. We read each and every email that comes in to us. And this week's question comes from Peter. And he says, I have followed TeamInvest for years, and he bought into Accent Group around COVID. So can you discuss what your really interesting charts say about Accent Group, or AX1, today? This is for Peter, a regular viewer. Sanjee.
Well, thanks for following us, Peter. We always appreciate that people follow us and try and learn and educate themselves to invest better. But I will say, just because of the way that you send a question in, it's very shortly worded. So I expect Peter has also done his own due diligence into buying Accent Group, and it's not just at the time of buying, but you continue to do that as the business changes and evolves. Because us at TeamInvest as members will follow a company and we'll continue to follow that company. We assess its risks, its moats, the management, and we do that constant assessment on a regular basis. Accent Group is one that's had a lot of evolution in it since COVID. You've had Brett Blundy that's now stepped away from being on the board, a great retail business mind. We've had Fraser's Group get involved, and they've been rolling out Sports Direct. So it's quite a bit of a game.
And the chairman's resigned.
That's right. So it's quite a bit of a game change over there. It's kind of lost a lot of, fallen out of favour with our TeamInvest members over the recent period. But it's it's a good business. I wouldn't say it's a capital killing business, but it's something that you'd want to just keep your tabs on and really understand that business and continue monitoring in a bit more detail.
So it is in a transformation period. Is that what we're saying about Accent Group? I mean, on Peter's behalf, it has lost a lot of value. There has been these seismic changes. Have you sold it?
I don't own it anymore, no. I did used to own it. So I did very well out of it. Could have done better if I'd sold it a little bit sooner than when I did sell it. I was a little bit slower than I should have been. But because I didn't sell it straight after Brett Blundy left the board and the chairman announced he was going to be retiring. But if you look at the way we discussed it in TeamInvest, one of the things we voted it very highly on was the quality of the board. And when the two most important retailers on the board, Brett Blundy and the chair, left, that should have been a red flag for anybody following it, that one of the things we thought was a big strength had gone away. We also voted that key man risk was a risk. Well, if 2 key men have gone, or we call them men, but I mean they could be women.
I get it. I'm not
have
too
gone.
sensitive. Yeah.
Okay, that's clearly something that's gone wrong as well. At the same time, they got a huge boost in COVID, because what did we do during COVID? We couldn't drive very far. We bought casual shoes, and we went out walking. So we bought lots of casual shoes. Now we've got lots of casual shoes in our cupboard. We don't need so many casual shoes anymore, because we're going to work, we're wearing more formal shoes, and we don't have time to go walking as much as we were doing before. So when we look at a company in TeamInvest, we don't say that's now a wealth winner permanently forever. We say that's a wealth winner as long as nothing changes. And at every meeting, when we do our company watches reports, we discuss if anything's changed. And usually the answer is nothing. But occasionally, like with Accent Group, there'd be quite a big discussion about all the changes, and most of the people in the room would say, well, shouldn't we do a review on this company, and do we still want to own it? And large numbers of people who did own it decided to sell it and no longer own it. But, you know, if you, as I always say to any member who says to me, oh, I won't be able to come for meetings for the next 6 months, I say, well, you're going to get pretty out of date. Things could change on a couple of companies in the next 6 months. So, you know, part of the process is keeping an eye on your 20-odd companies and seeing what, if anything, has changed. Great companies, not many of them change much, but Accent Group was one that certainly did.
Yeah. And I don't know that all the changes were for the worse. Some can be for the better, some can be for the worse. But the fact is they're changing. So as they change, you need to reevaluate your investment decision and saying, is that a company that I would pick again to be invested in? And keep understanding, okay, the risks have changed in that business quite considerably. The moats that they have changed. You know, the management has changed. So it ticks a lot of boxes that we look at on a regular basis. So it's if you're watching at home, I'd say you're doing that on your own portfolio and keep assessing what's happening.
If you're not a member of TeamInvest. All right, guys, thank you so much. Howard Coleman, TeamInvest, Sanjee Narendran, TeamInvest. Always great to have you guys here. So that's hopefully given you some food for thought about whether incentives drive behavior. So think about it. Are you really investing in the business or in the people running it? Thanks for watching Wealthy and Wise. We look forward to seeing you next week.
Wealthy and Wise is your guide to value investing, powered by TeamInvest.